Hi guys, Tim Melvin coming to you from down here in Southwest Florida once again. As you can tell, I'm still dealing with these rather pesky sinus issues that just refuse to go away. As this is the time of the year when I guess just everything that even wants to be pollen explodes down here in Southwest Florida, and I am paying a lovely price for it. Oh well. Anyway, first day of the month, looking at all the asset allocation models that I track. Everything's saying the same thing, especially the core model that I like to use, which was developed by Dan Rasmussen and his team over at Verdad Advisors. And I made a couple minor tweaks to it, but that's all. Completely out of big stocks, 100%. The trend following aspect of that has kicked in during the month of April, so we would be out of large cap stocks, indexes, large growth stocks, all of that. The model is saying, nuh-uh, time to go home. Been telling you this was probably going to happen soon. You got 40% long inflationary assets. This is one of the tweaks. You can use precious metals, which is what Verdad advises. They advise positioning gold. You can use gold, silver, copper, but you can also use oil and gas and MLPs and other inflation-sensitive assets under my tweaks. We, of course, have been aggressively bullish on MLPs for quite some time, and that consists most of our inflation positions are mastered limited partnerships, throwing off a lot of cash and seeing their value increase, thanks to shortages of new pipeline supply and the inflationary pressures we're currently seeing. The bank aspect of the portfolio, of course, we hold that 100% entirely separately. Cash has come down in that portfolio to about 31%. We are actively looking to add new small banks to that portfolio as they meet our criteria. The more prices fall, in spite of the fact that the banking industry is doing fantastic and is in great shape, the more prospects we will have to add to that portfolio. If you're not a subscriber, I suggest that you go to marketfi.com, find Banking on Profits, and sign up now, because we're having a good year already. I think we're going to have a great year and once again average double-digit takeovers for 2022. We are, of course, well on the way so far. Right now, we're just crushing the markets, as I said. I'm very satisfied with the performance of all of our portfolios. We're leaning on quantitative stuff. We would still have right now the 40% in inflationary positions, a small 10% of our portfolio in the small cap value private equity replication portfolio that tends to outperform under a wide range of conditions, but it works best when we are buying during an extreme bear market. We're in the early stages of what may be a bear market, not quite ready to call it that yet, but it's not time to be an aggressive buyer in that portfolio. I did get some time this weekend. The granddaughter was over, so we did some cooking out and a whole bunch of other stuff. So it wasn't a bunch of time, but I did get time to test a new variation of a shareholder reward model. We're looking for stocks that are paying very nice dividends, that are increasing that dividend by at least 10% a year, and have increased it 10% in the most previous year, most recent year, and are actively buying back stock, reducing the shareholder count by at least 4% over the past year. The model does fantastic. It crushes the index over both long and short-term periods and is going to be a strong candidate to replace the index and large cap portfolio component of a portfolio when the light turns green again. As I said, coming into May, the light has gone red, and we should be out of our larger cap positions for now, according to the models. Now, we did have the Berkshire Hathaway meeting this weekend. Warren Buffett and Charlie Munger didn't say anything new, anything unexpected, anything that we really haven't heard before, but it's usually worth kind of recapping what their positions were. Buffett and Munger both compared the market to a big gambling arena and said that it's getting worse instead of better. There's more gambling going on. There's excessive risk taking going on. I know I see it all the time, particularly among the retail investors who are just constantly searching for that magic return, that magic bullet that's going to make them rich by next Tuesday. It doesn't exist, of course, but we're seeing derivatives, Bitcoin, highly levered exchange traded funds, options, all the usual suspects coming into play more and more frequently. And both Buffett and Munger took notice of that fact, although Munger quite correctly pointed out that sometimes all of that excessive gambling and speculation has created massive opportunities for Berkshire Hathaway. And they took advantage of it this last quarter. They bought a lot of Occidental Petroleum when Carl Icahn was selling and closing his position out. I expect a lot of that stock got crossed from Icahn to Buffett because the timing is kind of fits that idea. We saw him take a big 9.5% position in Activision, betting that it will get through the Justice Department and Microsoft will be able to close the deal. And they also bought a stock that's been out of favor for a while, been creeping back up with energy prices, but they bought quite a bit of Chevron in the quarter. So those were the three biggest positions that Buffett and Munger put on to take advantage of all the wild speculation going on out there. So, big bets on energy too, in two of the three stocks, which we like to see because we are very bullish energy. Going back over the numbers this week, there's just no way that we get to where they're telling us we need to be on renewable energy under a reasonable time frame without lowering the standard of living for everybody on Earth. Oil and gas have to be a part of this picture. Yeah, let's transition. Okay, let's move towards renewable energy. Let's move towards solar. Let's move towards wind, towards hydro, whatever the source is. I'm a proponent of nuclear fuel, but let's accept the fact oil and gas are going to be with us for a while. We got to find some ways to increase what is now a structural lack of oil. Demand is rising, supply is falling. That's not a great equation for the global economy in the near-term future. That's a problem that's got to be solved. Should work out very well for energy companies. Glad to see that Warren and Charlie actually agree with me. Once again, they both come out and dismissed Bitcoin. Warren said that, it's got a lot of magic attached to it, as do a lot of things. And what he didn't say, but I'll say it, I've seen magic attached to a lot of different investment themes during my career. They've always blown up and exploded. Buffett also pointed out that, if you buy a farm, you've got food that you can get off of it. If you buy real estate, you're going to collect rents. It produces something. Bitcoin at this point in time produces nothing. And it's not a currency. Only Congress has the power here in the United States to make and appoint and anoint currencies. And I can see, and neither can Warren, any valid reason that Congress would decide to replace the US dollar with Bitcoin anytime soon. In my eyes, that makes it a speculative digital asset. Have no idea how it works out. If you're making money and you're comfortable with it, then I think you should continue to do that. If you really don't understand it and you're just trying to jump on the latest craze, that might have a different ending for you. Now, the government argument has kept me out of directly owning Bitcoin the whole time. I am a firm believer that at some point, some government somewhere in the world is going to get up, as China has already done, and said, I will not tolerate a threat to my sovereign currency. That will be the end of Bitcoin as we know it. That may even come in the form of a Fed coin, a digital dollar, if you will, sometime in the next couple of years. I don't know enough about it. I don't understand the technology. I do understand blockchain well enough to know that as the speed of the blockchain accelerates, that is going to become a very valuable technology. The coins itself, I don't have much use for them, although I do have to say that through a closed-end fund that I do own a tiny position in some of the Bitcoin miners and digital asset companies. So not direct ownership, but I do have some there. So just in case I'm totally wrong, I'll still make a little bit of money off the deal. All right, let's jump into a high-yield bank for you guys this week. It's Pacific Premier Bank out in Irvine, California, Southern California. PPBI is the symbol. This is just a great bank. It's taken a hit after it didn't meet the analysts' always accurate expectations here recently. But looking at this bank, we got 61 branches around Southern California with about $21 billion in assets, very high return on assets, very high return on equity. This bank was just voted by Forbes as the fourth best bank in the United States. They've been reducing the securities portfolio to build cash so that they can reinvest that because they believe quite obviously that interest rates are going to continue to move higher in here. They did experience, like a lot of banks, a little bit of negative mark-to-market losses on some of their securities portfolio. But it's worth noting, in most cases, many of these securities are going to be held to maturity. So that loss is just going to accrete back naturally over time. So the bank has plenty of capital. Non-performing assets ratio is just 0.15%. So they're doing a fantastic job evaluating loans. They are primarily a business bank. Most of this loan portfolio is commercial real estate, multifamily real estate, and commercial and industrial lending to businesses. In spite of that usually being considered higher risk lendings, These guys are specialists in it. It's pretty much all they do, just a 0.15% non-performing assets. And the equity to assets ratio is about 50% above other banks in the industry at 15. So they're phenomenally well capitalized, have plenty of cash and capital on hand to handle just about anything that the markets in the economy are going to throw at this bank. So we've got the fourth best bank in the United States. It's sitting here trading at less than 9 times earnings. We're going to see a very nice pop in earnings in 2022, I believe, going into the second half. They're in a great position to acquire other banks that catch their eye to add to their portfolio. They're not too big for another bank that wants to be in the Southern California business lending markets to make a run at Pacific Premier. At the same time, we've got a very low PE ratio, got a very nice yield of 4.21%, and management's been really good for the last couple of years at growing that dividend at a pretty high rate. So anyway, there you have it, guys. There's your high yield bank of the week. A couple of other thoughts on the markets. I would continue to avoid anything in the indexes themselves, large cap growth stocks here. I like the small cap banks, a little bit of private equity replication, and we're constantly digging for those special situations that we think can give you a great return no matter what the market does. When I find them, I'll bring them to you guys. In the meantime, if you're not already a Banking on Profits subscriber, get over to marketfi.com, Banking on Profits, and get signed up, and let's make some money together over the balance of the year. I'm Tim Melvin. Thanks for watching. I'll be back later this week.